So we are going to cover two very important things here in this video. Why tomorrow could be such a substantial day for SoFi, for a lot of the stocks that we are invested in, aka stocks that have a very high short interest. On top of that, I want to talk about what happened today, why we got so much bad news, but the market's absolutely ripped. For an example, SoFi was up 5.25% today, and you had the Fed come out and say some very hawkish statements. You had Microsoft cutting their guidance. You had a lot of bad news, but the markets didn't care. They still went up. We need to talk about it to put all of this into a little bit of context. Hit the like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. No matter where you are, no matter what time it is, it's always a good time to get your financial education on, baby, to better your lives and better your financial futures for you and your family. So shout out to every single one of you guys. Now, let's talk about it. Exactly what is going on today, first and foremost. So this might be a little bit complicated to try to explain, but basically how the markets work is they look at forward statements. They look at forward thinking, right? If you knew, for an example, an asteroid was going to destroy the Earth in 6 months, you would see the stock market drop 50% the next day, right? Or 20%. It would just get halted every day, down 20%, because why would you invest in the markets? It doesn't matter what happens in the next 2 quarters at any of these businesses if the world was going to end, right? So the markets are forward looking. Well, what has been happening right now is the markets have this perception of a recession, earnings are going to be terrible, you know, and what you're getting out of like the Fed, what you're getting out of certain companies was not that picture. So the markets are very disconnected from what the expectations are and what the market expectations are. For an example, for the S&P 500, we are currently expecting growth of 10.1% in revenue for the top 500 companies in the world. 10.1% in 2022. Yet you're getting all of these headlines about a recession, negative GDP, cutting earnings forecasts. Not looking so good, right? So you had analysts come out today that actually started to cut their price targets, to cut their earnings expectations at stocks like PayPal, stocks obviously like Microsoft, right? And cutting those price targets down. And essentially what that does is it narrows that disconnect here, because in the market's eyes, you know, markets are pricing in a decent chance of a recession, growth slowing down in a meaningful way, whereas the analyst and the Fed is over here saying the economy is good. There's a large disconnect there, right? So if you start to see analysts and the Fed, you know, starting to retract, the Fed talking about they cannot control a soft landing, just those people, those analysts, those important figures for the markets, relatively speaking, put that in little air quotes, that disconnect becomes a lot more narrow, and then expectations can become more clear. Like, for an example, Microsoft, they lowered their fourth quarter guidance, citing unfavorable foreign exchange rates. And essentially, the markets have already priced this in. Like, go ahead, look at Microsoft's chart. It looks a lot better than a lot of other stocks, but the markets knew damn well that Microsoft was not going to hit the numbers that they were expecting. This stock is down about 21% off of its highs, right? So the markets have already discounted these things, but it's like, you know, getting lied to from someone. Like, even if it's not a big deal, they're still lying, so it's still a negative thing, right? So that's kind of the best way to put it with these weird analogies. There's more certainty. There's less of a disconnect now than there was. Now, for the Fed, and what that news actually was, Fed Vice Chair Lael Brainard says it's very hard to see the case for the Fed pausing rate hikes. The key points: Federal Reserve Vice Chair Lael Brainard told CNBC on Thursday that she doesn't see the central bank taking a break anytime soon from its rate hiking cycle. Quote, "We've still got a lot of work to do to get inflation down to our 2% target," she said. Despite worries over inflation, Brainard expressed confidence otherwise in the economy. So a little bit of a good and bad thing here. Like I said, you're getting a more narrowed consensus. The last thing you want is expectations just everywhere, and then the markets don't know what to figure out. Like in Microsoft's case, right? The markets have been waiting for these earnings expectations to come down. In the meantime, the markets have already priced in that plus some more, right? That's why Microsoft's down 21% from its highs. So if they come out, guide down a little bit lower, the Fed says, hey, the economy's still okay, guys, we're not really worried about it, then there's a little bit more confidence there in what the number is likely to be, right? So that's very important, and that's what ultimately happened today in the markets. Hopefully that made some sense. If it did not, I can try to explain it better in another video, because it's very important to understand market pricing and the market psychology behind these things. But just as a rule of thumb, you want to see people in line with their expectations, so the markets know where to value companies. If there's just too many expectations, they're too wide and far in between, then like they were obviously a little bit more a couple weeks ago, it was really, really bad. That people don't know where to value companies, and you can see those big swings, sometimes overshoots to the downside, like something like SOFI, or you know, overshoots potentially to the upside, things like your safety stocks, like food stocks, healthcare stocks, oil stocks, right? So there is that. That's what really happened today in the markets. Those are the big things. Now, as far as tomorrow, what we're going to get for economic data, we're going to get a couple things. So we're going to get the unemployment rate 8:30 a.m. Eastern Standard Time, and the non-farm payrolls at 8:30 as well. 8:30 participation rate, 8:30 average hourly earnings year over year. Non-farm payrolls at 8:30 as well. Manufacturing payrolls, government payrolls. Then you're going to get at 10 a.m. ISM non-manufacturing PMI. So that's going to be very important, as well as the non-farm payrolls and the unemployment rate. So be on the lookout for that. That's definitely going to move the markets in the morning. 8:30 in the morning, obviously that's going to be pre-market, so there's probably not too much you guys can actually do about that one. But 10 a.m. you're definitely going to see a big move in the markets as well around that time, when the ISM non-manufacturing PMI comes out. On top of that, you do have Fed Brainerd again that speaks tomorrow at 10:30 in the morning, so that is also going to be pretty substantial. Definitely commenting on some of the data that we'll get in the morning, and that should hopefully, you know, give the markets a little bit of bullish enthusiasm to close out the week. But nonetheless, what is actually going to be happening in the markets that could affect SoFi, could affect stocks like AMC, you know, DraftKings, stocks that have very high short interest, is essentially this executive order. So executive order 14032, and it says it could be a big deal for AMC stock, but it's actually for stocks that just have a very high short interest, where there's a lot of hedge funds with short positions. SoFi is included in that. If we do go ahead and take a look at SoFi's short interest with the Ortex data, you could see that we're looking at a short interest of about 17.35%, which anything over 10% is considered extremely high short interest. Now, what this executive order is essentially saying, hey, hedge funds can no longer use Chinese securities as collateral for their margin debt, essentially to stay in short positions or to have just long margin debt, right? Just to buy and own stocks. So given where the markets are at, it could be a very big deal. This is actually what caused a lot of the most shorted stocks in the past, in January and in June. Think to AMC when that stock did make really big moves. This executive order is actually the thing that did cause that, because when you got the bond market that's destroyed, you got the stock market that's destroyed, you got real estate that is really starting to soften in a big way, you have just everything. All equities around the world have taken a major hit, and then on top of that, if you're using Chinese securities to collateralize your margin debt, well, now you can no longer use that, and that's a pretty big deal because China is the second largest economy, and there's a lot of investments in China. So we'll see what happens. Last time this executive order was only in effect from May 27th to June 2nd, and that's what happened obviously when AMC went on its parabolic rally. And then it was essentially they essentially kicked the can down the road 365 days. So it does go into effect tomorrow, and it could be substantial for a lot of stocks with very high short interest. So that's something I did want to point out. I don't know. I'm not a fortune teller. I don't know if it's going to make SoFi stock or these stocks go up in a big way. but it does seem more likely than not given the correlation that we've seen in the past with that executive order. Now, nonetheless, the Ortex data, like I said, 17.35% short interest of free float. Current shares that are sold short of 126.24 million. Cost bar max sitting at about 6.5%. It's came down a little bit, but it's still extremely high. 100% utilization. Days to cover sitting at 3.71. Free flow out on loan 28.29%. So you're definitely seeing some degree of I wouldn't even call it like shorts covering, but they have returned some shares as of recently. So there's that. You do have another insider buy from Anthony Noto as of yesterday. He bought 21.21 thousand shares worth $150,000, now owning 3.35 million shares, owns 0.37% of the company. So it's good to see all of these insider buys. Obviously, I'm sure the numbers look pretty damn good to see them buying shares this frequently. So that is all good. As far as the option activity, 100% positive order value, 4 orders totaling $701.48 thousand. A lot of these July 15th calls that are coming through for the $5 strike, $53,000 order right there, $117,000 order right there, and then a $121,000 order right there. It looks like these probably came in from the same hedge fund, betting that SoFi stock will be higher than about $7.43 per share by July 15th. So that is definitely a bullish bet nonetheless. Now let's go ahead and take a look at the chart for SoFi stock, and we can see we've pretty much flatlined out. We're kind of based out, but we are right on this 50-day moving average. 50-day moving average is at $7.44 per share. We're currently at $7.41 per share. So we're seeing a lot of resistance around this 50-day moving average. If we can break out above that, that is likely to send the trading algorithms into somewhat of a buying frenzy, and then we could see that next leg up, possibly to $8, $9, $10 per share. That's very possible if you do get a risk on sentiment. People make fun of me for saying sediment, but sentiment in the markets, and that would be very good obviously for SoFi stock. I don't think we're going back to $20, $25 anytime soon, but I do think if we did see a move back to like $10 per share, it could be a good opportunity to sell some calls against your position, collect some sweet premium, and potentially go out and buy yourself more shares of SoFi. SoFi is really going to balloon and blossom into this company that we know it will be, really, once you do get the student loan moratorium out the way, as well as when a recession comes and the federal funds rate gets dropped down, say down to like its COVID lows, back to 0 or back to 0.5% or 0.25%. That's when I think you're going to see a lot more lending actually pick up in the auto sector, in credit sectors, in housing sectors, all the different sectors essentially. So that's that, and I think that is really end of 2022, if not, the beginning half of 2023. That's when you want to have your full SoFi position ready to go and to ride out for a very long time, in my personal opinion. So that is going to be all for this video. That is what you guys need to know. Everything else is pretty neutral. Nothing really has changed as far as the RSI. That's at 53.47. Pretty neutral. The MACD also pretty neutral, but slightly bullish. So thank you guys for watching. Get yourself free stocks with Webull, Moomoo, and Public down below in the description of this video. And if you guys want to support the channel, link for Patreon down below in the pinned comment as well. Thank you guys for watching. Appreciate every single one of you guys. I will see you in the next one.